Welcome back. Some statements coming in from Maruti Suzuki, and once again, the company is highlighting affordability issues in the small car space. Mr. Bhargav has been very vocal about, the pressure felt by buyers in the entry-level cars. And even in the month of May, the entry-level segment sales were down 13% in the month of May on a year-on-year basis. The company goes on to say the sentiment in the urban market is not positive, and they are calling for some sort of incentives to revitalize the small car segment. The stock is down close to about 0.5%. But as promised, let's go across to Nigel, who's in conversation with Kunal Tayal, the senior analyst for India IT, cement and real estate at the BofA Securities, from the sidelines of the conference. Nigel?
Hello, thanks a lot for that, Reema. Yeah, Kunal's in conversation with us. Hi, Kunal. Good to have you on the show, and good to be here at the conference as well. Kunal, let's start off with tech first. Tell us, how are you feeling about the tech sector? Plenty of uncertainty with President Trump. There are pullback of deals or delay of deals as well. For the sector on the whole, how are you feeling? What's your preference, between mid as well as large cap as of now?
Sure. Nigel, thank you for coming over to our conference. On the tech sector, firstly, look, it's been a couple of tough years for the sector, and some of our work was indicating that things were starting to change at the start of the year. Of course, lots has changed since then. Our recent work is telling us a couple of things on how it is moving since April. Number one, on the positive side, it doesn't seem like all this uncertainty has pulled down spending to the extent it was feared. So what we are getting is that obviously there is some pressure on discretionary spends, but then there are several other areas of the technology spend pie where customers are still continuing with their journeys. So that's on the positive side. So, in a manner of speaking, the dip that has transpired from, let's say, a month of March and onwards has not been as intense like was being expected in the street.
So that's good.
That's good. Conversely, there was also some hope building up that with the movement in the tariff situation, a 90-day pause, talks of a deal with the UK and China, there could be an end to the uncertainty. We are not picking that up. In fact, a lot of our findings are suggesting that the 90-day pause may actually serve to be, a phase of uncertainty for this entire duration. And if a deal were to be concluded at the end of that is when certainty could return. So in our view, what you're looking at is a slow taper off in IT spends, but the uncertainty sort of continuing for a couple more quarters.
Yeah, all right. So, Kunal, just wanted to take forward a couple of those points then. In this sort of an uncertain environment, what would the preference be? Some of those large cap names, if I look at the cash flows, as a percentage of market cap, they look fairly well placed. Yeah. The problem is that there is a lot of uncertainty. However, there will be mid cap names that will grow at a faster clip. So large caps growing at an anemic pace, while mid caps growing at a faster clip. Though it comes at expensive valuations. What's the preference?
In our view, the large cap to mid cap trade-off has already played off. It's been the case for a while that mid caps have been the faster growing companies, and the markets have priced them according to that.
Okay.
Likewise is true for the large caps, where you described that the growth rate is on the lower end of the curve. And therefore, on a go-forward basis, as we are looking at investment returns, Nigel, our style is more absolute, and we are looking at very specific criteria across large and mid caps, rather than preferring any one bucket over the other. In terms of what is it that we are looking at, 3 or 4 things. Number one, we think that there are certain areas which could be called as secular winners.
Okay.
So companies that have exposure to data and analytics is one area where we think that companies with the right exposure will definitely benefit from that, first up. Second, there are companies with a well-defined right to win. So in the large caps, you have some companies which are very strong in cost takeout deals that can really help them perform better than the peer set. On the mid caps, we've seen a couple of strategies play out. Either you're very strong in sales and marketing, or then there are niche areas where, again, you have credentials which are particularly strong. And the final one is, margins is often a less focused thing in the IT sector. But again, what we find is that there is a set of companies where even in the current uncertain times, they might have scope to expand margins from the current levels, which may not apply to other companies across the sector.
Okay.
And this is our pecking order. This is our screening criteria for looking at what we favor in the sector.
So right to win, data analytics, as well as possibility of margins expanding as well. You want to give us your top picks, which you all have already published out, from the tech pack itself?
I would stay with the screen that we are using, Nigel. We are not. I wouldn't be getting into the individual.
Okay, let's shift away then from tech to cement, more domestic facing.
Yes.
Cement has had a horrific FY25, if we could say the least. Volumes didn't pick up, pricing was under pressure, and profitability took a hit as well. Now there's hope that FY26 will be far better. How are you all placed on the cement pack, and what would you all prefer out there? The larger cap names who are dominating the industry, the likes of the Adani Group, Ultratech as well? Or do you think the smaller ones could relatively do better because the delta could be higher out there?
Absolutely. I mean, cement's been a very interesting sector. Like you pointed out, the volume story wasn't exactly great in FY25. Yet, if you look at the stock performances for most of the companies in the sector, I'm sure you'd agree that they held up pretty well.
We're looking ahead.
Looking ahead. Exactly. So, so in terms of, therefore, what we think will be the incremental factor in the sector, we think that last year when the stocks didn't fall as much, that was because the street was looking ahead to volume sort of recovering once the new government settled in. For us, really the incremental factor is pricing, because all through last year, pricing was weak. There was not too much of a confidence on pricing power returning. I wouldn't say it is an established trend, but at least Q4 has started, a fresh round of hope.
Okay.
That after a tough 2 to 3 years on pricing front, this parameter can recover for the sector. To your question, therefore, as to what are the names that will do well, if this is the criteria, at least in our observation, pricing is a bigger leverage for the mid-cap companies on their EBITDA per ton outlooks versus the large caps.
Okay, all right, interesting. And before we let you go, let's touch a little bit about where the cement is used in the real estate space. We had the management of DLF, Mr. Tyagi, last week, and he was going all guns blazing, saying the best is yet to come. What is your take on the real estate basket? Normally we have this 10-year cycle. The real estate developers, they say we're in the first couple of years. Analysts say in the middle years. And the bears say that we're towards the end of it. Where do you think we are?
All right. So, I'd put it as year 5 of the upcycle. That said, CY24 wasn't without its share of challenges. We heard that there were at least a couple of soft spots last year. Industry supply was an issue as approvals in pockets were slow to come by. And pricing was starting to rise at a very fast pace. That exactly isn't ideal for the sector, if especially you have to make the case for a 10, 12, 15-year cycle, take your pick. The good part is that both of these aspects have started to show signs of settling down. Pricing is sort of back to rising at an inflationary level, plus minus. And supply, you often hear that Bangalore was the worst hit, and the Bangalore-based companies are starting to tell you that it's starting to resolve itself out. And therefore, our expectation for the real estate sector is that on a go-forward basis, these companies should still be able to compound bookings at about 10 to 15%.
Okay.
Given the price increases that have already happened in the sector, we think that the EBITDA growth for the companies can actually be faster, and therefore, overall, we're still positive on the real estate sector.
All right. What about the Delhi NCR market or the Mumbai market? What's the preferred, or you like the mix of both?
Little bit similar to the mid-cap to large-cap on IT. The market plays are pretty well established for the street, where Delhi, it's been viewed with an element of caution that investment demand might be taking over. The other markets are considered stronger.
Yes.
And therefore, our picks are more contingent on what is the availability of land bank that developers already have at their disposal. Because remember that, I was indicating that supply has been an issue. Therefore, in our criteria or screens, developers, that have a good visibility on land parcels and therefore visibility on launching new projects for the course of next 2 to 3 years stand to benefit the most.
All right, Kunal, it's been a pleasure hearing your thoughts. Thanks a lot for joining in and speaking to us here on CNBC-TV18. Well, guys, we got a little bit of a view on tech, on real estate, as well as on cement. Rima, a little bit for you, a little bit for me. Back to you in the studios.
And indeed, and for real estate, we're in year 5, but the EBITDA growth is going to look up from here on with the pricing power, the pricing increases that we've seen, and I think bookings compounding at about 10 to 15%. That should also hold. Interesting conversation coming through on all the sectors. Get into a break. On the other side, we'll talk more on markets. This time, we'll invite Anirudh Garg from Inva Asset PMS.